Good evening, everyone, and welcome to the Tata Metaliks Q1 FY23 earnings conference call hosted by Monarch Network Capital. Just a reminder that all participants' lines are in listen-only mode right now and muted, and request you to keep on mute for a proper conference call to happen. After the initial remarks from MD sir and CFO sir, we'll open the floor for questions. And the manner we'll follow is that you shall have to raise your hand and I will unmute you and you can go ahead and ask the question. I request you to limit the question to 3 so that everyone gets a chance. Over to you, Sandeep sir, for the introductory remarks. Thank you.
Yeah, hi. Good evening, everybody. Can you guys hear me clearly?
Yes, sir.
Okay, so Sahil will start. I think I'll keep my statement brief. If you have read the press release, I think it captures the Q1 performance very succinctly. But just for the benefit of those who might not have read, I'll just briefly talk about it. Q1 performance has been terrible, in one sentence. Even though the revenues have been up by about 11% compared to, let's say, year on year, Q1 of FY22. But sales volumes have dipped by 24% in case of pig iron and about 8% in the case of ductile iron pipes. The profit before tax has come down from 134 crores in Q1 FY22 to just over 1 crore, 1.73 crores to be precise. Now, the question is, why this terrible performance? And we will explain that, and we will also like to give you the confidence that this is a one-off quarter. We have actually the 3 major factors for this terrible performance. One is on the account of government, which is outside our scope. Second is market, and third is operational. So all these factors have conspired, in a sense, to work against us. So let me start with government. As you all know, Government of India imposed an export duty of 15% on pig iron and other steel products on 22nd of May. So 15% export duty on a price of pig iron which was running between 60 and 65,000 rupees per ton meant almost 10,000 rupees of immediate drop. And pig iron is a daily market. It's a daily market, it's a weekly market. So, almost 10,000 rupees of realizations down, which if I multiply with the volumes between 22nd, 23rd of May and end of June, we lost almost 40 crores in EBITDA over that period. So that was one. Secondly, if we look at the spreads of pig iron, that is between the prices of pig iron and coke, which typically in the last 5 years have averaged at a level of, let's say, about 5,000-6,000 rupees per ton, actually became negative or break even, and actually negative. And this was the lowest ever spread in the last 10 years. Why? Because coal and coke prices went through the roof. There is still no explanation, very clear and cogent explanation for why the coal prices went up by so much. Just to give you some figures, in the month of March, the coal prices, that is March this year, the coal prices touched a high of $670 FOB from Australia. And if you look at the prices a year back, that's in Q4 of FY22, let's say January to March last year, the prices were at about $100 to $110. So it's a 6 to 7 times multiple jump in prices over the last 1 year. And that, really, in a sense, crushed us. This kind of a movement in raw material prices have never happened. This was the highest ever, and the spreads were the lowest ever. So that was the second factor. The third factor was the operational. We took shutdown of both the blast furnaces and the ductile iron pipe, all of this in one quarter. Normally we phase it out so that the impact is averages out. Unfortunately, we took all of them together, and there were reasons for that. One of the furnace was not operating at its most efficient manner, So we thought it's better to take the shutdown and repair the refractories now. And in any case, once a year we have to do it. And therefore, that impact was also significant, both in terms of volume, the shutdown cost, and of course, fuel rate. So all of this has actually hit our bottom line tremendously. And that is why this performance. Now, if I look at how is Q2, well, the pig iron prices have stabilized. In fact, they are looking up now. The coal prices have dropped. Let's say if we take the figure of May, in the month of May, the coal prices, average price was $508. That's average of prime hard coking coal. That's now come down to almost $275 in the first 15 days or first 14 days of July, the average of July. The spot price is actually $240. So within 2 months or within 1.5 months, the prices have actually halved. Therefore, the coke prices have accordingly coming down and have come down. So what does it mean in terms of spread? The spreads from negative have now moved to positive territory. So therefore, this is looking good. Positive now, still not recovered to the same level of 5,000 to 6,000, but coming close to it. So that's the positive. Ductile iron pipe business, coming to that, it's been a weak quarter. Why? Firstly, because the prices have been so volatile, the buyers have been holding on. They've not been picking up because in anticipation of price drops, they have just held on to the orders. So they were releasing orders on a monthly basis rather than on a yearly basis or on a 6 monthly or 9 monthly basis. But with prices stabilizing, I think order release will also begin to happen. On a positive note, the Government of India's investments on Jal Jeevan Mission, which is the flagship project of the Jal Shakti Ministry of Government of India, is now estimated to be over 1,25,000 crores in FY23 from the central government alone. There is an equal participation, 40 to 50% from the state as well. So we're looking at 2 lakh plus crore of investment, which is likely. In reality, this may be much lower. Just to give you a sense, in FY22, that is last year, total investment by the central government was only about 20,000 crore under Jal Jeevan Mission. As against 20,000, the announcement or the budget total, including unspent amount, and is now 1,20,000. Overall, it gives a positive impact. There are some other numbers on DI pipes orders. The visibility of DI pipe orders on projects together is roughly about 5 to 6 million tons. The installed capacity is, let's say, 2.6 million tons. So we are looking at order visibility or project visibility of 2.5 years, which is tremendous considering today's industry order load of hardly about 7 months. I will summarize, I'll close at this and start on with the question answers. Sahil, so I'm through with my opening statement, which is pretty long, but I thought it's important to explain. Thank you.
Thank you, Sandeep sir. So we'll just wait for a minute for the question queue to assemble. Yeah. Rohan, you have raised your hand. Please unmute yourself and ask your question.
Sure. Thank you, Sahil. Am I audible?
Yeah, yes, very much.
Good afternoon, Sahil, Sandeep sir. Good afternoon.
Good afternoon.
Thank you for the address. I just wanted to understand that bulk of the impact in the cost which we have seen is from the coking coal side. So how are we managing that? Because in the note also it was written that our coke costs have gone up by 30%. So are we doing any change in our strategy in procurement of coking coal, or and what is our current inventory? At what quotation period or what blend cost it is?
You're talking about coke cost?
Yes, coke or coking coal. Do we procure coke or coking coal, sir?
Yeah, we do both. Actually, we have our own coke ovens, but that serves about 80% of the total coke consumption. So about 20% we buy from the market, 15 to 20%.
Okay, understood, sir. And how are we placed in the price terms, sir? What is the blended coal cost per ton? At what and inventory I'm asking?
Yeah. So while I'll give Shubhro to answer in detail, but just to give you a sense, the coke prices, which were ruling at almost close to 60,000 or above 60,000 rupees per ton, let's say a month or 2 months back, have now come to slightly above 40,000. So they're already down by 50%. Okay, but the impact of that will start getting, visible in our stocks only, let's say, from the second half of July or August. Okay, so the cost is already down, number one. Number two is, since 80% of our coke is in-house, which means we import coal for that, we have fortunately not bought coal at high prices, too much of coal. So we've actually held on to very minimal inventory in the last few months. Therefore, the impact of the high cost inventory on our, let's say, overall cost will be much limited, I would say. But I'll give it to Shubhro, our CFO, to respond to that in more details.
Yeah. So, and Visa has answered. So your first question was the inventory level, where we are in the normal circumstances, the inventory level is at 3 months to 4 months. But as we have bought less in the last 4 or 5 months, and we continue to buy less, we are having an inventory level of 1 or 1.5 months. So fortunately, we'll be able to take the benefit of the lower price faster. Your second part of the question was that what about the strategy? Now, on the strategy, earlier also we have talked that the coal cost is one of the major costs in our cost structure, and one of the way we can keep our margin intact is to have some predictability about the coal. So we are seriously now working on the hedging of coal based on the firm order of the DIP. Because the DIP order book is normally 8 to 10 months, whereas the coal is maybe 2 to 3 months. So to match both the asset and liability, we'll try to do some more hedging of the coal.
So Shubhro sir, just to if I'm understanding it correctly, you are saying that whenever we'll book a long term like 6 to 10 months DIP contract, we will correspondingly buy coal for that contract. So we know at what price we will serve that particular order.
Yeah, you're partly correct, because the coking coal market is not that liquid. It is illiquid market. So we may not be able to do 9 months kind of long position on the coal. But presently some normal inventory is 3 months. We'll try to do 3 plus 3, at least 6 months visibility should be there.
Right, sir, right. Understood, Shubhro sir. And in one of the last earlier conference calls, this was mentioned that Tata Metaliks does some coking coal hedging. Is this the hedging you were talking about, sir?
Yeah, we are talking about this.
So, Rohan, just to come in here, 2 points what Shubhro is saying. One is, of course, the hedging of coal. So that's one. Secondly, what you do is you tend to order more coal, which we had done last year, actually. We ordered for almost 6 months. So there is a working capital cost, but then you hedge up. So especially when you're buying at $100 and the prices move up, that helps. So, but of course, you need to take those calls. Second one is the hedging on the exchange, let's say Singapore Commodity Exchange. And number 3 is, which the ministry has now introduced in a much wider way, is the WPI of pig iron. So the DI pipe prices are being linked to WPI of pig iron. It was always linked, but very few state governments were actually including that in the contracts. Now the central government Jal Shakti Ministry has had a couple of meetings with us in the last 2-3 months, and there is an agreement that we should link it up. Because what is happening is that the contractors, EPC contractors, also can't handle such a massive increase in prices. So with the result, the DI pipe projects were getting delayed. And that is also the reason why only 20,000 crore got spent last year. But as this thing, WPI of pig iron gets, adjusted to the DI pipe prices, it to some extent cushions the cost impact. Okay, so that's the So the three ways.
Understood, Sandeep sir. So we are saying we will be doing hedging in all the three ways. On exchange also we will be doing, apart from the physical.
Correct. The third way will be common for everybody. So it's not only for us, but that's also getting operationalized now in a much wider, larger way. That's at least the intent of the central government. And that's the advisory that's going to the states.
Understood, Sandeep sir. Thank you, Sandeep sir, Shubhro sir. Thank you, Sahil, for the opportunity.
Thank you.
Yeah, Mr. Saket Kapoor, you may go ahead and ask the question.
Namaskar, Dada. Good afternoon.
Good afternoon, Shakir.
Sir, coming to where you just explaining to us, sir, about this WIP of pig iron prices, if you could elaborate the abbreviation WIP stands for?
No, WPI.
The inflation index you are speaking.
Yeah, wholesale price index of pig iron is declared by the government every month. So, just like the other WPIs. So,
so it will be indexed to that.
Yeah, it will be indexed to that.
Okay. So, sir, have we seen this implementation or only the circular is there? They're taking into account the order booking, have that been implemented into it? Enforced also?
No. So some state governments were already had already implemented it. So now the central government has realized that its projects are not moving. And one of the main reasons is the volatility in prices. So they constituted a committee. And in that committee, we had also sent our recommendations and we had interacted with them. So that committee has concluded that WPI needs to be included in every contract and that advisory is going to the state governments or it has gone, whatever. So I'm saying going forward, that will get taken care of to some extent. Okay, not fully, but to some extent.
May I continue, Sahilji? Hello?
Yes, please. There was some disturbance from your side, so that's why I muted you. Yeah.
ठीक है सर, मैं mute करता रहूँगा.
Go ahead.
Yes, sir. About this inventory part, sir, if you could explain this 73 crore of inventory surplus, sir, which we are seeing in the for this quarter.
Saket, you are talking about the change in inventory in the P&L?
Yeah, change in inventory.
Yeah, so there are two reasons. If you see that in March 22, our both PI and DIP inventory was all-time low. Maybe one is below 1,000 and second one is below 2,000. Both has gone up. PI is more intentional. As the price was in a free fall mode, we have intentionally we have not sold and kept inventory. And as MD sir was saying that in the month of July, there is a upside on that inventory what we have held. In DIP, normal inventory is 5,000-6,000, but March was very abysmally low. But also, as the end of the June, there was a lot of issues on the sites and to some extent of the customers. Maybe 2,000-3,000 more we could have sold, but doesn't matter. We will be able to make it up in the queue. So pig iron is intentional. DIP is okay time. Is it?
So this one will get evened out in this quarter only, sir?
Yeah, definitely.
So, Shakir, I think the way to understand is that the inventory of finished goods has gone up in this quarter compared to previous quarter. But that is natural. In March end, you will always find we try because it's the year end. We make all the efforts because the projects also need to, complete in terms of their financial capital. So everybody wants to, buy up and use up that capital. So usually the inventory is one of the lowest. And this year in particular, that is FY22 March, we have one of the lowest ever inventory in the recent past. So from a very low base, in quarter one, it has gone up, which is nominal. I think it hasn't gone up so significantly, but because the prices had also moved up, pig iron and DI pipes. Therefore, the value of inventory looks much higher.
Correct, sir. Sir, we spoke about this planned shutdown and also the performance of the blast furnace not at optimum level. So today, where are we in terms of optimum production, and also how are the blast furnaces refurbished and how are they performing?
Yeah. So both the blast furnaces we took shutdowns, the annual maintenance shutdown. Typically, it is for refractory repair, and it's a once in a year that we do. So one of the furnaces was having operational issues, and so we thought we rather combine it with the shutdown instead of doing it later. And that is what happened in April and May. But it took a lot of time to do that, because to order the the equipment, the contractor, all of that takes time. So that is why I explained to you the poor performance is also on account of that. Now June onwards, especially second half of June onwards, the furnaces are performing well, and they are in a same way as what they used to do, let's say 6 months back or whatever, or let's say what they did in the month of March. So we are now back to the normal levels, and I hope that quarter 2 will be much better from an operational perspective as well.
Sir, on the pig iron front, you quantify that 40 crore was the EBITDA loss we incurred, if I'm correct, sir, for this June quarter. For this shutdown and the upkeep and the additional cost, can you quantify the on a ballpark number what have been the hit for us on account of this maintenance and shutdown?
So on account of the export duty and on account of shutdowns, the total impact on EBITDA would be anywhere between 70-75 crores.
You articulated about this four factors, I think so, which you explained earlier. So out of those factors, just putting aside this export tax part issue, which is also on the relook if we take into account the current steel prices. So how are the other factors currently aligned for our business? If you could give some further and understanding, and also on the order booking currently, and how are the DIP prices currently in what vicinity, sir? If you could answer.
Yeah. So I mentioned about 3 factors: export duty, and I said 40 crores on account of that. Then I said there were spreads which have been negative. Now I don't want to account any factor because spreads keep varying, and that's a market-related thing. The third one was operational, which is maintenance shutdowns and the loss because of the operational issues. That I said number 1 and number 3 together was about, let's say, 70-75 crores. So if 40 crores is on account of first factor, the second factor is roughly about 30-35 crores. Okay. So does that explain? So that's the first question. As far as DI pipe order book is concerned, we have roughly about 7 months of order books, and the DI pipe prices, they have from a level of, let's say, 50,000 rupees per ton a year and a half back, they have moved up to 85,000 rupees in the month of June. And now with the softening of raw materials, they have come down by almost 10%, let's say in the last 2 to 3 weeks. So obviously the drop in DI pipe or the increase in DI pipe is much slower, because pig iron moved up, let's say, from 30 to 60, 65. But DI pipes moved up from 50 to say 80 or 85. The increase also was not so much. Similarly, the drop also is unlikely to be so much. In any case, the order books for next 6 to 7 months we already have. And with the greatly increased demand, if the government outlay of FY23 actually plays out, then we'll keep the prices at a reasonably high level. May not be at the same level, but at the current level, but at a reasonably high level. So to me, the H2 of this year is going to be crucial, and they are going to be, much better than what we would have seen in the recent past.
Right, sir. So I'll come in the queue for the follow-up. Yeah, yes, definitely, Sahilji. I'll thank you for this opportunity. I'll come in the queue.
Mr. Gaurav Jain, you may unmute yourself and ask a question. Mr. Gaurav Jain, you may unmute yourself and ask a question. We'll take a question. Mr. Vikas Singh, you may unmute yourself and ask the question.
Good evening, sir. Thank you for the opportunity.
Good evening, Vikas.
Sir, I just want to understand, you talked about 2 lakh crore plus kind of the investment from the government, but you also said that the realistic assumptions is lower. So can I have what is Tata Metaliks realistic assumptions in terms of the government investment in the sector?
So, to give you a sense, last year the government spent, let's say, the central government spent, let's say, about 20,000 crores on JJM, Jal Jeevan Mission. There is an equal amount from the state government, which is expected to have come in. So, let's just assume the central government investment. Now, central government in allocation for this year, including the unspent amount of last year and the unallocated budget of last year, together comes to about 1,25,000 to 1,30,000. Out of which, if we assume that only 30% gets spent, I don't know how much will get spent, but let's say 30%. My own sense is maybe 30%. That would take the figure to about 35,000 to 40,000 crore, which is almost double of last year. But you can imagine that I am hazarding a guess. The government expenditure will depend on various factors, including their own actual liquidity and their own cash flows. But so far, the tax receipts have been robust, and there is a lot of pressure I understand, from Prime Minister's office on the Jal Shakti Ministry to complete the mission in the next 2 years. In my opinion, that's just not possible. So it will go on. But my sense is that it will go on till 2030. Okay, maybe 70-80% will get completed by 2027, but the next 5 years. But because of that, we can see that the movement and pressure from the Jal Shakti Ministry on the players to supply material. There have been a number of meetings and interactions. I have had a meeting with the Secretary Jal Shakti, on various issues, and I understand what their mind is. So they are very sincere about it, and they are pushing a lot. But how much of it will actually come through is a little difficult to say. I am guessing maybe 30%.
Understood, sir. Sir, given if industry push best kind of the production and volume, so what kind of the basically portion or the volume together industry can execute in an year's time if everybody tried to push for 100% of the production? So I just wanted to the maximum, whatever the government desire, but there is a limit to industry in order to fulfill those desires. So what is the maximum industry can push in terms of volumes?
So the industry capacity is roughly about 2.6 million tons. There are some expansions happening and new ones coming, like Welspun. Then our Tata Metaliks expansion is going on. Okay, so let's say the capacity goes up to 3 million tons. Typically, the operating capacity is at about 80%. So let's say 2.4 million tons. So if we have 2.4 million tons, and if the total visibility of projects and actual orders, and I can give you some breakup of that later, is coming to almost about 6 million tons. So I can see that for the next 2.5 years, there is a clarity in terms of how much orders have either come in or will come in. So because the industry can only do, let's say, 2.5 million tons.
Understood, sir. Yeah. No. Yes. Sir, just one last question in terms of our capex. So can you just tell us where we are, how much we have spent, and by when our first batch of 1 lakh ton of DI pipe would come in?
So capex, typically we are now spending 250 to 300 crores per annum on capex. That should grow. Yeah. Roughly that is the expense. Okay. And this year will be on similar lines. As far as the DI pipe new capacity is concerned, the new line, the phase 1 has been commissioned, okay, more or less, and because there are different machines and different lines, so there are some teething issues which are being sorted out, but production has already started, and we normally take about 3 months for everything to be stabilized. So from H2, the main production will come out. Although production has already started, even last month there has been some production. July, this month will be better. And obviously, as we go, we'll start running 3 shifts, let's say from second half of this month. So I think we are on track. There have been delays on account of machinery coming in from China and also the technical engineers not being able to come. So I think I'd mentioned that using digital technologies like augmented reality, we have been able to commission the plant, but obviously, that is slower than doing it a physical way. So it has taken time, but the production has already started and we should see additional volumes coming in, particularly in H2 from the new plant.
Understood. And matching blast furnace capacity has also been increased.
Yeah, so blast furnace already has excess capacity, but we had also, debottlenecked. Rather, there was a project to debottleneck it to increase the capacity. So roughly, you can assume that a capacity of 6 lakh tons of blast furnace is there after this debottlenecking. 6 can go up a little bit. So let's say it was 5. We produced, I think the highest we produced was 565, right? So from 565, we can go up to 6 lakhs easily. But that would happen may not happen this year, may happen next year, 6 lakhs. But so we'll tell you because there are various things on the anvil. So capacity wise, we are good enough. As far as DI pipes is concerned, the capacity of the existing plant is 2.5 lakh tons. And the new capacity is another 2 lakhs or 2.5 lakhs. So we'll still be at 4.5 to 5 lakhs with the 2. So there'll still be a surplus of 1 to 1.5 lakh tons minimum on the hot metal side.
Understood, sir. Understood. Thank you for taking my question and all the best.
Thank you.
Mr. Ashif Patel, you can unmute your light and ask the question.
Good afternoon, sir. My question is, are we expecting any shutdowns in terms of in any of our blast furnace in near future?
No, there will be no planned shutdowns. The long one, typically every month there is a small shutdown, which is okay, which is already considered in the plan. But normally the annual shutdowns are all over. So we expect the next 3 quarters to be much better in terms of operational performance.
So over next 1 year, entire year, we won't be seeing any volume loss in terms of arising from the maintenance shutdowns as such?
No, maintenance shutdown there would not be. But there is one of the furnaces has to go in for a major overhauling and repair. So that we will tell you once the time comes in. That's more likely towards the end of the year or early next year.
Sure. And sir, you explained in very detailed manner the procurement and entire protocol which you follow in terms of procuring coking coal. But can you explain me what would be our average inventory prices of coking coal right now?
May I request Subro to respond whatever you can give? Just to give a sense.
If you see that in the initial remarks, what you were saying, in the month of May, the coal price was $500. In the month of June, $370. And in the month of July, so far, average is $275. So we have got some June coal. We still have got hardly any May index coal. We have got. So as in the earlier, I was saying that fortunately we are having only 1 month and 1.5 months. So majority of the coal is June index.
So can we expect it to be roughly around $350?
How much?
Around $350.
June index was 370.
Okay.
And July index so far is 275.
Sure.
So for the quarter itself, you can take the number what you have stated.
Sure.
But it will also depend on what is the price
in the future.
Forward.
Yeah, true.
Yes.
If you can see in August it goes up to 350, we can tell.
And next question to the sir. Export duties of 15% were announced in May end. So
Can you speak a little away from the mic? Your voice is,
Yeah.
Yeah, go ahead, please.
Yeah. So my question is that export duties of 15% were announced towards May end. So we only effectively saw 1 month of lower pig iron prices in this quarter because of export duty. But next quarter, entire quarter would be these duties would be applicable. So do you see the realizations holding up to the current level, or do you expect them to slightly on a softer side?
See, the pig iron export duty was implemented or made effective on 22nd of May. So we lost almost about, let's say, 30 days there and maybe 9 days, 8-9 days there. Okay. But I think after that, the raw materials have also come down. What's more important is the spread between the finished good and the raw material, rather than the absolute value of price. So as I was mentioning, in the quarter gone by, the spreads were negative, in the marketplace. Okay. Or maybe just about break even. Those spreads have now come into positive territory. The average spread over the last 5 years is, let's say, about 5,000. We have still not reached 5,000 in the first 15 days, but we are inching towards that. And the pig iron prices have also started moving up. We have already revised prices in our markets. So I think we are now getting into positive territory and things should be much better.
Sure. Sir, what percentage of total DI pipes volume?
Asif, can you come back in the queue, please?
Yeah, sure.
Yeah. Yeah. So Abhishek Ghosh, you may unmute yourself and ask the question.
Yeah. Thank you so much. Am I audible?
Yeah.
Yeah, hi, sir. Thanks for the opportunity. Sir, just in terms of the Jal Jeevan Mission, the entire number that you've given out, 20,000 this year and, possibly a higher number in FY23. What is the proportion of DI in that?
I didn't get your question. Proportion of DI in what?
So is that number of 20,000 crore that is entirely spent towards the DI, or is it towards the entire Jal Jeevan Mission? That's the number.
Okay. So that's the government's investment on Jal Jeevan Mission.
Correct.
So the central government's investment is, let's say, about in FY23, we estimate is going to be about 1,30,000 crore, 1,25,000 or 1,30,000.
Yeah.
And roughly 40 to 50% of, so roughly half of that will come from the state government. So total is, let's say, 230, 240,000 crore. Is what is a theoretical number.
Sure.
In reality, it's going to be, let's say, 30% of that or 25% of that. Is my estimate, and I can be wrong.
Yeah.
Out of the total spending, how much is for the DI?
So DI pipes, out of that, typically you can take about 20 to 25%. Depending on a lot of factors, it depends, but roughly whatever is the investment, you can assume that 20 to 25% would go towards DI pipe supply.
Okay. And that is what you are referring to as a 2.5 years kind of order backlog.
No. I'm talking about the total investments. So if, let's say, we talk about, let's say if the expenditure is 30,000 crore and let's say 25% or 30% of that is on DI pipes. So it's say 10,000 crore. But that's on Jal Jeevan Mission. There are other projects as well.
Yeah. Okay. So given that the opportunity space is so huge compared to what is the current capacity, are you seeing a lot of competitors putting up a lot of DI capacity out of that 2.5 million tons? But are there any sense around that, and how difficult is it to get the qualification and other things? Some thoughts there.
So DI pipes industry has a high market entry barrier. Okay. Both in the marketplace as well as on the operational front. It's not like making a steel pipe, wherein you get a hot roll coil, you buy the hot roll coil from any manufacturer, turn it around, weld it, and start supplying. This is a pretty complex process, and it's not easy. You don't get manpower, you don't get easily trained manpower, and then, of course, there is a lot of technical glitches to it. So anybody who comes in new faces a lot of these issues, and we have faced that when we set it up in 2009. So we know that. Number one. Number two, on the market side, typical of government projects, many of the contracts, the state governments, contracts will ask you to show an experience of, let's say, 5 years, 3 years, 7 years, depends on. So they don't get access to all the contracts. So there are restrictions. So the first few years are not so easy for a new player. The incumbents obviously have an advantage, and therefore both on the operations side and on the market side, the incumbent players have a definite edge and will continue to command, let's say, premiums and certainty from the customers.
So since there is also a lead time, fair amount of lead time in putting up a DI plant, from the current 2.5 million ton of capacity that India has, what is the broad sense that you have, how much capacity is kind of coming through?
From 2.5 million tons, as I was mentioning, we will go up to, let's say, 3 million tons by, let's say, next year.
Okay, got that. And so just one more thing in terms of the pig iron part of it, how are you seeing the overall demand? While you spoke about the spread part of it, that it was kind of negative in this quarter and now it's kind of improving, not yet back to the 5,000, 6,000 levels, but if you can just talk about the demand as well in terms of sectoral trends, it would be helpful. Thanks.
Yeah. So, pig iron, roughly about 12 to 13 million tons are traded internationally, out of which 50% comes from Russia and Ukraine. So pig iron, when the Ukraine-Russia conflict broke out in February, 50% of the trade was gone. So the prices in US, let's say, if you look at, there's a place called NOLA, New Orleans. Okay. There, the prices were, before the outbreak of the conflict, were, let's say, at a level of $550 to $600. Post the conflict, start of the conflict, the prices zoomed up to 900 plus. Okay. Those prices have now come back to a more realistic level at about $650, $670 since, let's say, last couple of weeks. So prices have stabilized from that perspective. The demand in the US market and European market continues to be strong. There's a demand-supply mismatch because obviously a lot of material from Russia and Ukraine is still not coming in. But they are finding their own ways to go in, but obviously it's at a reduced level. So demand-supply mismatch in the international market is still there. The 15% export duty, what it does is reduces our realizations. But because there is a demand-supply mismatch, the overall price of pig iron is almost about $100 higher than what it was in, let's say, early February in the international market. If it was $550, now it's $650. So it's more or less now stabilized. So that's the sense internationally. Domestically, because the prices are very high, the consumers of pig iron, or let's say the customers of pig iron, put a hold on purchases because it was not making sense for them. But the domestic players, suppliers of pig iron, started exporting, so they could manage. But now exports are not as remunerative, but the domestic demand is now picking up, and also because of labor going away to Bihar and UP and all that, they come back in July because of the sowing season. The season will now start in many of the foundry clusters like Ahmedabad and Punjab and Delhi. So the demand should pick up as we go forward. So to give you a sense of number, the foundry clusters, different foundry clusters were operating in at a capacity of 40 to 50% capacity utilization in the last quarter. They are moving up to, let's say, 60, 70% is what we have seen in the last 2 to 3 weeks. That's the sense we are getting. So things are looking better from a demand perspective, price stabilization perspective, and international perspective.
And this demand movement is because of auto? Or it is...
Auto is one, engineering is another one, agriculture is the third one.
Okay.
Tractors and pumps and all that.
Great. Okay, sir. Thank you so much for answering my questions and wish you all the best. Thanks.
Thank you, Abhishek.
Mr. Manish Goyal, you may unmute yourself and ask the question.
Yeah, thank you so much. Hope you can hear me.
Yes, we can hear you.
Yeah, thank you so much. Sir, on the segmental revenue, what you report in pig iron, the revenue which is reported is on a complete hot metal production, I believe, because when we try to arrive the number on the volumes, the realization looks to be much higher. So just wanted to clarify that we need basically how should we look at it?
If you see that segment report, the third line, it is the net inter-segment revenue is netted on. So if you reduce the pig iron sales, net it off with the inter-segment revenue, that gives the pig iron sold outside parties to the end customers.
Okay. Okay. And so, sir, just to clarify, you mentioned that now the coking coal prices are down to $240 to $50. So ideally, it is 20,000 rupees per ton, right, sir? Because earlier you said it has come down from 60,000 to 40,000. So I just want to clarify.
Scope then
60 to 40.
yeah, 60 was coke, and coke has come down to 40, and 250 normally goes to 20,000, but you have to consider the freight, which itself is been $20 kind of thing, $20 to $25, plus the customs, say the not customs, the non-zero customs, the port charges and the local freight. Okay, so we have to consider $20 for 2025 for the sea freight, another $20 for local freight and the
And sir, in DI pipes, the realization was around 60,000 rupees in the Q1. So when do we see the benefit of new order execution, and what kind of average realization we can see going forward, say in Q2 or Q3, if you can give us some perspective?
So the high price orders have been at 85,000 rupees per ton, not at 60. So that was DI pipe. So that's landed, the landed prices. Now those prices have softened by about 10-12% in the last 1 month. But that's okay because they're still very high. But what's more important is the spread. With coke prices having come down from, let's say, 60 to 40 or 42,000, the spreads are now much healthier. Right. What had happened in between was that the DI pipe prices were now almost competing, or the pig iron prices are competing with the DI pipe prices. So that was the problem. Typically, there is a gap between pig iron prices and DI pipes. Right. How much can we take that for an average sugar on long-term basis between pig iron and DI pipes?
7 to 13,000.
So anywhere between 7 to 13,000 rupees per ton, and they were almost touching neck to neck. So despite the increase in price of DI pipes, because of the raw material push, you are not making margins on DI pipes. That's why your margins on DI pipes have been affected. Your sales volumes have not come down drastically. Right. Yes, 49,000 in Q1 of FY22, we have done 45,000 this. It's only a 4,000 difference. But margins are not good at all because of the raw material push, which is a one-off. I would not say one-off, but I would say which is a more like an outlier. We haven't seen this kind of raw material push in the last 10 years.
Okay. No, so I was just trying to understand that when do we see that benefit reflecting in which quarter?
I just want to clarify one thing, Manish. When MD has said 80,000 and the softening up by 10%, he meant landed price including GST.
Yeah.
Right.
Okay, so that is, and in accounts, it is net of GST. So when you see the top line of either segment report or the normal report, it is always net of GST, but inclusive of freight. So whenever 80,000 or 75, first of all, you need to get it divided by 1.18. And if you do 80,000 divided by 1.18, you will almost find is almost 64,000.
Right.
Something like that. And we have already reached to that, say, 60,000 level kind of number. So I would be happy that if you can maintain that, sure. Because what important is the spread. If with this kind of pricing, if the coal price is like a 50%, the spread will be much healthier even with the 80,000, with the high price of coal.
Sure, sir. And last question, just to clarify on the pig iron domestic demand. Sir mentioned that the demand is improving now with the foundries utilization going up. So just want to get a sense, like what was the decline in demand and what are the current foundry grade pig iron prices, sir?
foundry grade pig iron prices were ruling at over 60,000 before the export duty announcement. They have come below 50,000, so almost more than 10,000 rupees drop. What else was your question? I missed it.
No, so like in probably last 4-5 months, how has the demand trend changed? Like it had declined and now improved. So just want to get a sense on that.
Yeah, I just mentioned to the previous questioner that the foundry were operating at about 40-50% capacity utilization. Now that is moving up, and some places we are finding it up to 70% also. So things are moving up. There is also the export demand because a lot of guys also export castings to US in particular. So that has now again moved up, and therefore the demand for pig iron is also moving. So I think in some way or the other, the export market, the international market, does influence our prices and our demand, either directly or through the end user. That's now having a positive impact.
Right, sir. Thank you so much.
Yeah.
Deepen Ghosh, you can unmute your line and ask the question.
Okay, sure. Very good afternoon, sir. Just have 3 questions from my side. My first question would be, in one of your earlier investor calls, you had mentioned that beyond 1000 mm, DI pipes cannot be used. So is it because of the price point that, steel pipes get more competitive, or is it like some technical aspect which does not allow DI pipe usage in application where it's above 1000 mm? And my second question will also be, outside China, I believe India is one of the biggest, a very cost competitive DI pipe player. But so what is the reason beyond it? Because while we are sufficient in terms of iron ore from the entire country perspective, but sir, I mean, India is still net importing country for coking coal. So what makes us competitive outside China? These 2 questions.
Okay, so the first question was 1000 mm. Okay. Yeah, so up to 1200 mm DI pipes in India are manufactured. In China, they go up to 2800 mm. Okay. But what we have found is that in general, for the larger dia, the demand is very limited, and mostly it is taken up by steel. So steel becomes more competitive. It has more flexibility. You can carry hot rolled coils to the sites and then have a mobile machine to weld them and manufacture, steel pipes, which is not possible in the case of DI pipes. So both flexibility of handling and ability to handle big dia pipes at project sites becomes complicated, in addition to the costing. So these are the 2 reasons why steel is a more preferred material of construction for pipes for larger dia. So that is your first question. And second question was?
Second question is that India doesn't have coking coal.
Yeah, okay. But competitiveness. So India is the second largest producer of steel. Why? It doesn't have coking coal, but it does have iron ore. It has a good ecosystem for the iron and steel industry. It has good manpower, and I think we are competitive, extremely competitive. And I think these factors, and a large market, domestic market, all of this helps in making us very, very competitive in the world market. And in fact, if you look at DI pipes, I would dare say that India now is perhaps the most competitive of the DI pipe players in the world market. China continues to be, but in many, many areas we are finding that we are better off than them when going to the export markets. And the reason for that is that Chinese government has put a strong restriction on emissions, on carbon, and they are going in for decarbonization in a big way, also on emission norms. That is adding to their costs. By 2025, the iron and steel industry in China has been told to kind of comply to certain norms. And also the fact that the export duty rebate, which the Chinese government used to give, I think which was earlier 15%, has now come to 5% or 6%. So all these factors have made the Chinese industry less competitive compared to the Indian industry. But this is in general. Again, player to player, it will vary. And the advantage that the Chinese have is economies of scale. They have large plants. So that's their advantage, but they are losing out on some of the other factors. So all in all, India is becoming more and more competitive. And I would dare say that some of us are perhaps more competitive than most Chinese players, but not the entire industry necessarily.
So I just want one clarification on the point. So below 1000 mm is DI cheaper than steel pipes?
In general, yes.
And just last one question, sir. You spoke about PI and PIG spreads. So how relevant would that metric be? Rather than looking at PI minus coke spread, shouldn't we look at PI minus coke cost per ton of PI? Because I mean, like you said, the way you were sounding that it's break even, or let's say spreads are negative, but it's not like you're loss making, right? Even let's say if pig iron prices are touching 1 lakh rupees and your coke prices are let's say 5,000 less, you'd make huge tons of money, right? I mean, just looking at absolute spreads or looking at the spreads per ton of pig iron, wouldn't that be more relevant?
Yeah. So it is only for simplicity and to give you a sense that we tell you. Otherwise, you're right.
Okay, you are technically correct,
yeah.
But all the plants will have got defined efficiency. Some has got 600 kg coke rate, some could have got 650, some could have got 550. So this number is purely for the simplicity.
So, but like sense to people as to where we stand.
Yeah, but sir, it's not like at negative spreads you would be loss making. That's not correct, right, sir? I mean, because because your fuel rate would be like 500 kilos of, let's say, coke and another 150 of around PCI, right, sir? When it comes to hot metal production.
Yeah, but
so that you are putting words into our mouth. But what we are saying is that directionally you are right. The spread being marginally negative doesn't mean we lose money. What I'm saying is that we are not making money. It also depends on the other costs, etc. But you're absolutely right that we need to see the actual cost of coke going into it. Since coke is almost about 60% of the cost, 65% of the cost. That's why, for simplicity, we talk about the spread of between PI price and coke cost. Otherwise, you need to get into other factors as well. How much is iron ore, sinter, fluxes, all of that.
Okay, thanks for your insights. So thank you so much.
Thank you.
So one question that is commonly asked in the chat is regarding the merger with Tata Steel Long Products. So any kind of update or any kind of progress you can address on that?
Not really, sir. I think, as I mentioned last time, you will get to hear from Tata Steel on that.
Okay, sir. Got it. Falguni Dutta, you can unmute yourself and ask a question.
Hello. Am I audible?
Yeah, go ahead. Yeah, go ahead.
So just wanted to ask you, what is the coke cost per ton of pig iron in Q1 for us? The absolute coke cost per ton of pig iron.
Absolute cost absolute cost of coke?
Yeah, per ton of pig iron.
So not per ton of pig iron.
I mean per ton of pig iron cost. I mean, let's say the cost of pig iron in Q1 per ton, what was the cost of coke?
Well, that would have got two factors. One is that what is the coke price and what is our efficiency. So if you see that what MD has said, the coke price was substantially higher, and it was almost 53,000, 54,000 rupees per ton of coke. He has also mentioned that in this quarter we have taken shutdown of both the furnaces in one quarter, which has led to the higher fuel. So if we talk about one numbers, that will not give any indication about the head of number. So we need to see what is the normalized coke price and what is the standard fuel rate of an efficient furnace. Accordingly, we need to reach or recalculate our coke cost per ton of hot metal or per ton of.
So let me just try and give you some numbers, give you some sense of the numbers. So let's say if 600 kgs if somebody is using coke of 600 kgs, let's say, and the coke price today is, let's say, 40,000. Okay, actually it will be more like 42, 43. I'm just for simplicity, I give a round off number. 40,000 into 600 kgs is 24,000. So 24,000 would be per ton of pig iron. That is the cost of coke.
Right.
Against a pig iron price, which is slightly less than 50,000.
Okay, sir. So got it. So current price is around about that, the number you mentioned for pig iron. I mean,
Yeah,
sorry,
correct. That's what I said. The foundry grade pig iron prices are today, let's say less than 50,000. Okay, it could be 48, 49, 50 depending on the market. While the coke cost per ton today, if I assume 600 kgs, it will depend. There is as the previous, participant said, there's also PCI, all that. So I'm just simplifying and saying if you're only using coke, then if your average number is 600 kgs, then you would spend, let's say, 24,000 rupees per ton of pig iron.
Okay, sir. That's helpful. Thank you, sir. That's all from my side.
Right. Thank you.
Yogansh Jeshwani, you may go ahead and ask the question.
Thanks for the opportunity, sir. Sir, if we look at pig iron as a whole, it is typically very volatile in terms of margin unless one has iron ore integration. So, and we also have DI pipe as an advantage, so we can use our pig iron production into DI pipe and continue to maintain stable margins. So, with this expansion, why did the management go for a higher DI capacity and utilize the entire hot metal production and make our margins more stable as a company overall? And if you could also share, going forward, will you be doing that directionally, like putting in more DI pipe capacity and reducing the pig iron sale that we do to outside market, or do we want to continue making some sale of pig iron and DI?
Theoretically, you're right. DI pipes gives you a margin of, let's say, 20% plus. Pig iron will give you more like 10, 12%. Okay. But what happens is that, it's a balancing figure as well. You can't have absolutely one-to-one, number one. Number two, it also diversifies your business. And when the business is good, so for pig iron, let's say last year, we had spreads of almost 20,000 rupees per ton. We made hay. We made 135 crores profit. That was mainly because of pig iron. So I think from both these factors, keeping some amount of pig iron is always good, and especially because pig iron, when we compare on a volume of, let's say, 3 lakhs or 4 lakh tons, then your margins are lower. But when the volumes come down to, let's say, 1 lakh, 1 lakh 50, your margins are much higher, because then you are serving geographically proximate markets. And, where we command a much better premium, freights are much lower. So then the margins are much better, maybe between 15 and 20%. So it's not so bad, unless your volumes are very large.
Okay, that's helpful,
Does
sir.
that make sense? Yeah.
Absolutely. One more question on the overall strategy side. Why didn't we go out to get our own iron ore mines when we had the understanding of how to run it because of Tata Steel, and also the cash balances on our books are pretty good, and that would have been a very logical step for us.
So we get our iron ore from Tata Steel mines. Most of the iron ore that we get is from Tata Steel mines. And we are not into mining, so we'll have to open up another, let's say, vertical. It requires management bandwidth. You need to have scale. See, earlier what happened, the mines were only for captive purposes. You could not sell. It's only recently that the government has allowed it. Okay. So you would produce, have an iron ore mine, but then not able to scale it up because your volume requirements are lower. So all these factors led us to not invest in a new mine and stick to our basics, which is to produce pig iron and DI pipes.
I just want to add one more point. That it is good that we have so far not invested. If you see the last year or last to last year, the iron ore mines got auctioned at the rate of 90% to 130% royalty. And on those mines, one of the biggest kind of thing that the trader who used to have 3 to 5 billion ton kind of iron ore. Now got totally, the mines got stopped. A lot of people, because of the higher royalty they have committed to the government, they had to reduce the production or cut down the production. That is one point. In addition to that, the people, those who have taken on that time, they are struggling a lot because the market price have crashed like anything.
So what he's saying is there was too much of competition for the mines, which resulted in obnoxious bidding. There was a bidding war, and people have bid all, extremely high numbers, and they have now landed themselves in trouble because that's their commitment to run the mine and to pay to the government. And so he says, in hindsight, in a way, it was a good decision.
Understood, sir. Last question from my end, sir. After this pig iron, DI pipe capacity comes up on stream, do we have more land available at the current facility to go for next level of expansion, or will we need a greenfield land site for next level of expansion, 2, 3 years, 4 years down the line, whenever that happens?
So we don't have too much of land. We think we can accommodate something more there in Kharagpur, which we have evaluated, but it's going to be a little tight. In any case, if you want to build something of for scale, we will have to go outside. We have been looking for the expansion outside. We've been evaluating, and as and when we find something interesting, we will obviously let you guys know, let the market know. But as of now, we don't have anything firm, either in Kharagpur or outside. In any case, in Kharagpur, the expansion project is still on. The first phase is more or less completed. The second phase will get completed next year.
Thank you, sir. That was really helpful, and best of luck.
Thank you.
Do we have time for one more question?
Okay, go ahead.
Okay. Sanjay Malik, you may unmute yourself and ask the question.
Good evening, sirs. I hear me?
Yeah, we can hear you, Sanjay. Good evening.
Good evening. So I just wanted to come back to the earlier question of the merger, and I know you can't sort of comment on timeline because it's a complicated and long-drawn process. But what's happened in the last 18 months is that, the world has become a very different place since you announced the merger. Whether it's political, economic, regulatory, everything seems to have changed. So now looking back 18 months, all I wanted to understand is you would obviously have had a strategy and decided how complementary the two businesses are and what the synergies are and what the accretion to your overall earnings per share would be. So I just wanted a general sort of feedback, if that's possible, on in standing here today, do you feel that all the assumptions that were made are generally favorable today or haven't changed much or are worse compared to what was the basis of the merger 18 months ago? Thank you.
So Sanjay, thank you for the question, but I'm sorry, I'll not be able to comment much on it. Okay, this is handled primarily by our parent Tata Steel. So it's best to put them this question and they will be able to respond to you on the timeline or also on the, how they see it. So please excuse me, but I'm really not in a position to respond to this question.
Okay, so the decision making for the merger is entirely driven by Tata Steel, and the two merging companies therefore don't really have a say in the matter. Is that right?
So the company we are a listed company. Obviously, we have a say. I will not say that, but I'm saying the justification and the strategy is a group strategy.
I see.
Because you're asking me about the group strategy and because the timelines have been getting extended, therefore I don't want to make any comment. Every time I say it doesn't get fulfilled. So I have actually got embarrassed too many times. So that's the reason I'm saying, please excuse me. I think
I understand.
Let it take its own course. In any case, whatever is there, Tata Steel will in any case announce it, communicate to you. So I don't want multiple channels confusing the market. So it is from that perspective also. I'm just trying to say that we will not like to comment. Don't get me wrong, it's just from that perspective.
No, I fully understand. The only point is that unfortunately there are two sets of shareholders, one of Tata Steel, of which I'm not a shareholder. So it's difficult for me to sort of relate into the two companies. Is there some way that someone can sort of connect? Can we connect to Tata Steel, or can they put out something that confirms that the basis of the merger is still intact? Is there some communication of any kind that can come out?
I'm sure, Sanjay, they will come up with some communication shortly. And I appreciate your point that you are a Tata Metaliks shareholder. So what, so you will get to hear something sooner than later, that much I can tell you. Okay. And I just don't want to, as I said, don't want to have multiple communications. And also because of the, a bit of ambiguity in terms of the timeline, there's no point in my talking about it. So it's for that reason that I'm not, saying that. But I have my understanding is that communication will come sooner than later. So just hold on for some more time. And if you don't get to hear from us sooner than later, and that sooner than later could mean in the next few months, then please, you are feel free to formally write, and we will try and see if we can get you a considered response.
Thank you very much, sir. Thank you. Thank you.
Thank you. Thank you.
Thank you. That's all, sir, for today. Just wanted to thank you for very patiently answering all the questions you and Subhra both. And also thank you all the participants for participating in the call. Sandeep sir or Subhra sir, would you like to give any closing comments?
Thank you, Sahil. I think it was a good question-answer session. I hope we have been able to clarify a lot of points. On the DI5 business, we didn't talk much, but I just want to close saying that, in terms of the order books, they are currently at about 7 months. But as I was mentioning, that Q3 onwards, I see a big thrust. And in terms of industry order load, currently it's about 1 million ton. And there is about roughly 1.5 million tons of, or rather 2 million tons of orders being negotiated currently. So 1 + 2 will make it 3 million tons. So this is a clearly visible order of the industry. So 1 million tons in hand, another 2 million tons under negotiation. There is another 1.5 million tons which is out for tender, but bidding has not yet happened. And another 1.5 million tons where projects have been announced, but bidding has not happened. So a total of 6 million tons of DIP is visible to us, whether ordered, whether tendered, or whether at project stage. Okay. So therefore, from a demand perspective, the DIP is going to be pretty strong, and therefore we from the industry feel very strongly about the bright, I would say, prospects of the DIP industry going forward. With this, I would like to close. Thank you very much, Sahil and Monarch, for hosting it, and to all the investors for hearing us patiently. Thank you. See you soon. Bye-bye.
Thank you.